Sure. Thank you so much, Mr. Mukesh, for this very interesting keynote address. Um, I would like to now invite our second speaker for the day, Mr. Shyam Sreenivasan. Um, Mr. Shyam is the CEO of Quantile AI, is the founder and CEO of Quantile AI, a New York-based startup. Shyam was previously at Morgan Stanley for over 20 years, where he led many transformational technology initiatives in various leadership capacities in both in New York, London, as well as Mumbai. At various points in his long career at Morgan Stanley, he was a global head of program trading technology, exchange connectivity, and algorithmic trading risk controls. He is a proven thought leader and innovator, creating many high-performance teams in fast-paced environments. Shyam is a domain expert in algo trading and analytics across equity and fixed income assets, asset classes, trading systems, quantitative finance, HFTs, and regulatory controls. Shyam holds a bachelor's degree in engineering in computer science from Bharatiyar University in India, a master's in computer science from the University of South Carolina, Columbia, master's in business administration in finance from Wharton School, University of Pennsylvania, and a certificate in quantitative finance from the CQF Institute. Shyam, it's a pleasure to have you join us today, and we look forward to your presentation. Please take it away.
Thanks a lot, Professor Nandan. Can you hear me?
Yes, very clear.
Very, very good. Yeah. Thanks a lot. First, before I start, I would like to thank Professor Nandan and IITM, Robert Bosch, Center for Data Science and AI for giving me an opportunity to speak at this conclave. Just to introduce Quantile AI, we started in 2018, just shy of 3 years, with a vision to be a very innovative startup at its core. Our sole aim is to bring the advancements of AI and ML to apply to real world problems. So we have identified some problems in finance, and that's our starting point. But our goal is to solve the real world problems that is, evading solutions for a very long time. And I'll talk about, what we are focused on right now. So we're based in New York, as Professor Nandan said. We plan to start our offshore unit at IITM Research Park in Chennai very soon, and as soon as the COVID situation improves. So we've launched 2 products that bring out the innovative applications of AI in finance. The first product is Eagle AI. It's our advanced enterprise risk management product to detect frauds and other anomalies from enterprise scale data. And one of the core areas that we are looking at is actually trading that Mr. Mukesh Agarwal was talking about. So we apply AI ML to detect all kinds of spoofing and layering and front running and various different patterns of trading to detect that, and so many other different anomalies there. With this, we hope that we can help firms save millions of dollars in operational losses and fines from regulators using Eagle AI. And you can find a lot more information about Eagle AI at www.eagleai.com. This talk is not about that. This is about the second product that we have. It's called Tengen AI. It's our investment management product that helps retail investors grow their wealth. In today's talk, I'll just focus on Tengen AI. Let me share the screen here. So can you see my screen?
Yes, sure.
Great, okay. So why are we talking about this? So we did a market survey with the help of University of Connecticut at Hartford to study the market. Primarily, we looked at like the millennial group of participants in the market survey, but we also expanded the reach to other investor groups. But largely what we found is most investors don't start investing early enough. People start at like age 30. Quite a lot of years have gone by, and the power of compounding, it's said that Einstein said the power of compounding is the greatest invention by a human. So that is lost for almost 8 to 10 years if people start late. So that's one study that we found. The second is people are largely influenced by friends on social parties and what they invest in. Somebody says, I like Tesla, and everyone says, oh, I should also have Tesla. That kind of influences by friends, which is not necessarily informed all the time. People may be lucky sometimes, but many a times they just burn the fingers by investing in the wrong products or wrong assets because their friends said so. They're not informed on broad market opportunities. People know all these big names like Google, Amazon, Teslas, etc. They may not know a lot of other companies that's up and coming until they get the headline news. So one is lack of information or imbalance of information between the big names versus the up and coming names. So that's the third problem that we found. Most decisions are driven by emotions. People buy when the market buys, everyone buys. When the market sells, everyone sells. Usually, the retail investors are the ones that get affected when they are driving their decisions based on emotions. And lastly, they are ill prepared to protect their gain in a market downturn because market goes up, everyone gets excited, but then everything is lost when market goes down or goes through a correction. But everything happens to be just a paper gain. They cannot really realize the gain. So these are all the big issues that investors face, and we wanted to see how we can address those issues from a practical point of view. So what are the modern day problems that we have? There are a lot of apps out there. Any market you go, there are trading apps. Even in India, I think there's plenty of trading apps, but none of these apps actually recommend or advise on what to buy, what to sell, and why something needs to be bought or sold, right? Even the classic Robinhood is a broker dealer. They cannot really, legally speaking, they cannot advise on what to buy or sell because they are unbiased broker. But there are not too many trading apps that does the advice to the investors. There are not enough apps that's designed to cater to millennial goals because millennials use a lot of apps. But what are their goals? They may have short-term goals, not necessarily something that they think about retirement at the age of 25. So there should be some apps that should be geared towards like the short-term goals that the millennial has, like buying a car, buying a house, etc. And then there are no direction for investors to invest in strategies which they believe in. They may have ESG or green investing as a theme. They might like companies that actually are socially aware. They're governed by diversity and so on and so forth. So that is a thematic investment that many of these products don't really advise on. And then lastly, there are no app that helps investors invest consistently and systematically to achieve financial freedom. So the discipline part of it, to be able to invest in the right kind of securities, to be able to pull out when the time is right, to be able to invest in other products where things are coming up. So that discipline is also obviously missing in a lot of investments. So these are all the modern day problems combined with classic problems of being influenced or biased. So our product is AI-based investment management solution. So how do we solve this problem? How do we try to solve this problem? Let me put it that way. We have the product take systematic decisions. It's driven by data and data alone. It's not driven by emotions. No individual person who codes it can actually influence that by saying, can you invest in this particular stock or that stock? Everything that comes out of the system is, in terms of decisions, are systematic. So that also gives the discipline that we just talked about in the previous slide. And then the ability to take informed decisions in a short span of time. So what do I mean by information? Information in terms of sentiments, what the analyst community is saying, information in terms of the fundamental data about different stocks, how they are performing in terms of their return of equity, return of investments, in terms of the financial, cash flows, etc. Then the third thing that we do is algorithmic driven. When we say algorithmic, we come up with our own scoring based on all the different factors that the AI engine comes up with. And then using that score, then we pick up various different themes that's based on volatility, themes that's based on sectors, and so on and so forth. And then, why we do it, it's cost effective, right? Because we apply discipline, because we apply machines, naturally the cost is much lower than applying people there, but we also get a huge benefit of having something that is well defined. So moving on. So in terms of history of investing, just in terms of just the evolution of where we have come, uh, purely from a brokerage point of view, back in 1975, SEC deregulated the fixed price brokerage commission, and they said any broker can decide what commissions they can charge. So that's back in 1975, almost 45 years back. Um, so that changed the whole dynamics of who can provide a brokerage or advice on investments. Then almost 15 years later, E-Trade is a huge company that's now owned by Morgan Stanley. E-Trade came along and said, okay, we are going to democratize uh, trading. And they brought in the $4.99 trade when it was previously more than $50 to trade a single particular stock. Now they brought the price down, way down rather. At that point in time, $4.99 was cheap. But then Robinhood took one step ahead, almost 15 years or 20 years later, saying that we're going to make it free. Of course, they get the monetary benefit elsewhere by posting these buy orders elsewhere for the hedge funds and whatnot. But for large part, Robinhood basically made that affordable to by anyone and everyone by saying it's free. So in year 2021, we are taking it to one level above, saying, okay, everyone needs the advice. Everyone needs that models like of discipline and whatnot. So we are going to provide that at a very affordable cost. So it's not free, but it's something that everyone can afford, regardless of what their financial strengths are. So why Tengen? So Tengen is a quant finance based combined with AI, robo investing designed to build wealth. So that's the main goal is, apply the advances in finance in the technology and quant finance and help the individual investors. So it's AI powered decision making. We make better decisions by giving them access to actionable insights, market research, proprietary research that we do. We have watch lists, so much more. So we have a research platform that does that. And then we also have quant strategies that pre-constructs these models. We have models that's focused on various different risk tiers, all the way from very conservative to very aggressive investors. And then the investors have got, of course, the choice to choose somewhere in between two. So we do have a wide array of things that investors can choose from. And then the systematic investment strategies helps individuals save for their goals in consistent and systematic manner. So this is a 1 minute video, actually 2 minute video. I hope it plays with the sound. So I'm going to play it here. So that gives you a very high level overview of what Tengen is.
Nowadays, there are way too many trading apps, but nobody to guide on which stock to choose and why, or if stocks are the right fit for us, or we should be investing in ETFs or mutual funds or anything else. Eventually, you end up following the crowd and transact into loss-making investments. Investing doesn't have to be hard, nor should you be paying huge fees to get access to information that helps you make data-driven investment decisions. Just like everything in life, we should have a friend or a guide that gives us the right advice in terms of investing without having to bear the heavy load of fees and charges. Think about it. How would your investment portfolio look if you had access to the multi-dimensional research that was only accessible to hedge funds, or have access to the black box strategies so you can invest and let your money grow, or also choose the amount of risk you'd like for a certain amount of return? Meet Tengen AI. Tengen AI was born to democratize investing. It gives you access to the actionable market insights, research, Tengen's proprietary ranking, investing strategies, marketing news, and a lot more, so you can start building wealth. Let Tengen be your guide. Tengen is built on 3 pillars. These are fundamentals. Think of it as getting to know the ins and outs of a particular stock or a company. Fundamentals basically mean analyzing stocks that involve looking at any data which is expected to impact the price or value of a stock. Momentum means the speed or the velocity at which the price of the stock changes. This helps the investors to determine the strength of the trend. Sentiments. Market sentiment is the feeling or tone of a market, or its crowd psychology is revealed through the activity and price movement of the securities traded in that market. For example, rising prices would indicate a bullish market sentiment, while falling prices would indicate a bearish market sentiment. All you have to do is link your existing portfolio or create a new one with Tengen. Tengen helps you optimize your portfolio. It also gives you a 3-month outlook on stocks. This is done by backtesting analysis, which considers the 3 pillars of Tengen. If you'd like Tengen to take care of your investments, all you have to do is invest in Tengen's black box strategies and let Tengen make money for you. Stop speculating, invest wisely. Let Tengen be your guide.
So that's a 2-minute pitch about what is Tengen in terms of the research that it provides. There's a lot of ranking information across the universe of invest quality stock. We don't look at everything. It has to be a certain market cap, certain volume for us to actually pick those stocks or ETFs. We also apply it on mutual funds too. So what the unique proposition of Tengen is, we look at it as a 3-month forecast because AI is really good in looking at short-term trends, short-term momentum, and so on and so forth. So we are, at any point in time, there's a 3-month outlook. So we keep looking out for 3 months, and of course, adjusting at a 3-month kind of frequency. And when we backtest our models, we have got spectacular results. I'll just share some at the end of what we are talking about here. So, but compared to a typical robo-advisor that's looking at like almost a 15 to 20 year horizon, and they just invest in some things which is very passively, and then wait for that asset to grow over a period of time in a gradual fashion. But ours is more active asset management in terms of looking just in short periods and keeping up with the pace of like where the market is heading. So Tengen AI strategies, as we said, algorithmic driven, backtested to perform during adverse cycles. We target returns from 15 to 40. Actually, we should update it to 8 to 40% because we do have strategies for people who are really conservative and say, I want to preserve capital, I don't want to risk it. So we do have strategies that actually gives them 8% on an annual return compared to an expectation of 3 to 4% if you go with the traditional advisors. So we have 3 different family of strategies. Genesis is the starter series where we focused on ETF-based models. Again, these series has got like 5 different tiers: very conservative, moderate, aggressive, and very aggressive. The Elite series is focused on stock-based models. Again, very focused on certain themes, certain kind of investments. So this is where it actually tends to look like hedge funds in terms of the kind of growth that one can achieve for the amount of risk that they take. And then we have the Exotic series, which is only for the accredited investors to be able to take even more higher risk in terms of short positions and investing in futures and options, etc. So these are the 3 main series of models that we have, but our algorithm also helps an investor balance their investment across these 3 series. So it's not like an investor has to be only one or the other, but they can be in 2 or 3, depending on the risk categorization that they belong to. So given that, I'll just share 1 or 2 performance chart here. So this is 1 performance chart we have for the Elite series. So the orange graph here is what our Tengen model would achieve. This is a historical backtested results for 6 years from 2015. So there were 3 market downturns during that period. One was in 2016, the other one 2018 and 2020. 20 was a big one because of COVID. But you can see that consistently, the scale here is pretty large, like from $10,000 to $50,000. It's almost 5 times or 4 times more growth of the $10,000 investment. So there's almost 400% return over a 6-year period compared to about 200% return in the traditional index base. And this index is a very high risk index, which is NASDAQ, which has got a lot of technology stocks there. So the volatility is relatively high in this index, but we basically use that as a benchmark. And you can see that, the return is really spectacular compared to even that benchmark. So that is on the Elite series. And then the Starter series, which is Genesis, the scale here is 24,000, 10 to 24, so it's almost 200% rather than 400%. But this is for a moderate risk category here. And we compare it with a lesser volatile benchmark here, which is S&P benchmark for moderate investments. So there we are, again, consistently above the benchmark right from the get-go, but we are able to then increase the gap as the time proceeds. And the more an investor would stay with this model, again, the discipline of being able to look at market 3 months ahead and to be able to invest in what's the trend. And what we see that is you're not like every 3 months dumping what you have and then getting to the next one. It's usually a very gradual phase of like rebalancing or reallocation. That's what we observe, that winners are always winners, are mostly winners, and only some actually go down, and you're basically adjusting your weights to something that's coming in the horizon. So that's basically the Genesis model. So in summary, what Tengen is achieving, we are live in New York. At this point in time, we do have investors on our models. And in summary, what we are trying to do with Tengen as a product is bring the advancements in AI, machine learning, and combine it with quant finance and provide the financial freedom, which is an important goal of every investor. So an investor should be able to like quit their job at the age of 40 and say, I've got enough money that I earned in the market. So that's the goal that we have set ourselves, to be able to give that financial freedom to everyone. Why should rich have all the fun? Everyone can have the fun. So that's our theme. The mantra that we have is, why should rich have all the fun? Where we should make the fun part of investing to bring it to everyone. So that's that. And in conclusion, we make important by using AI, we can make important investment decisions. The errors associated with human decision making actually is reduced or minimized. By formulating various algorithms and then exposing them to substantial volumes of relevant data, such as market prices, we are able to let the machine do a lot of work which a human cannot do. And we can train the models very quickly with going back in time. And we can identify the mispricing, the historical correlation that exists between securities, where the correlations are deviating now, and the fact that it has a historical tendency to come back again. So there is a lot of these market inefficiencies or mispricings that we can actually identify with the application of AI and quant finance. So as a result, we can bring those treasures out to investors to be able to take the opportunities, exploit the market opportunities that it presents to generate the alpha, and which in turn turns into higher returns for the investments. And as I said, we are currently live in the US. Later part of this year, we are planning to go live in Europe. And next year, we are coming to India. So that's it for questions.
Great. Thank you so much, Shyam. I have collated some questions from the audience, but please do feel free to, after this session, perhaps go through the set of questions from the panelists in the Q&A component, and you might be able to answer them yourself directly after this session as well. Okay, so one of the questions is, what role does interpretability of the recommendations itself play, and to what extent does that, I mean, first of all, does Tengen care about interpretability? So does it care about a human's ability to understand the coherence of the recommendations or the lack of it, and so on? And to what extent does that limit you in terms of the models that you could potentially use versus the ones that you're constrained by?
Sure. So what we apply is an ensemble model in our approach. So just like how a person who has got a medical ailment would go to a Dr. A, and then he's not satisfied with the answer with the Dr. A, he goes to Dr. B, not yet satisfied, he wants a tiebreaker, goes to Dr. C, and eventually he takes all the inputs from A, B, C, and then makes his own decision as to what course of treatment that the patient wants to go through. It's similar to that. We take an ensemble approach, we take fundamental data, we let that fundamental AI models to actually churn through the numbers and say, this is what our recommendations are in terms of rankings. And then we take the same approach with the technical part of it, which is the market data-based signals. And each of these models has got more than 50 different factors that we take in. And the third model is the sentiment data. And the sentiment data, we have got both the crowd sentiments as well as the analyst sentiments. So we buy some sentiment data from the market data providers. So each of these models work independently. And then, of course, it has historical data as its background for predicting what it's going to predict for the next 3-month period. But then we funnel that into our ensemble model that takes the 3 different inputs and then say, for each of these securities, what these 3 inputs have translated into, which of these models have actually gotten better accuracy from a historical point of view. So we apply that into each and every stock-based model, and then finally come up with our Tengen scoring. And in this case, obviously, we know which, if something is being recommended high, we know the weights that's been assigned to a technical versus the fundamental. So we know what drives the ranking in that particular case. So in the case of Tesla, probably the market sentiments is driving most of the upswing of the value, not necessarily the fundamental data, not yet at least, right? But that's not the case with IBM. It's driven mostly by fundamental, because no one cares about what the analyst thinks about. It's all about whether IBM was able to produce results or not in their quarterly earnings statements. So every stock has got its own characteristics, but we are able to interpret the rankings based on which of these factors actually play a big role in making that ranking come up. So I hope that answers the question, Professor Nandan.
Understood. From the customer's perspective, is the one part that I would belabor role in the recommending system. Your answer kind of alludes to how the process that is currently taken and how that helps with interpretability somewhere. But is interpretability itself an end goal that you closely monitor from the perspective of recommendations?
No, I mean, we do give enough color for the investors in terms of where a particular stock ranks in its technical, fundamental, and the sentiment aspects of it. So we are giving the colors to say this is what our engines are predicting, and this is what we expect this particular stock to do in the next 3 months. And then we give a score. We come up with a score which is normalized across every single stock out there. So that is the best interpretability. I mean, we don't have a human that says, okay, this is what I expect this particular stock to do. It's all driven by data, and data is the Tengen score that we come up with. So yeah, I guess to answer your question in a different way, we really don't care about a human interpretation of why a particular stock is expected to go up. It's all driven by data, and we are supporting that with our Tengen score and some color in terms of the 3 different aspects that we look at.
That's very clear. Another question from one of our panelists is, as when you take you're essentially a fintech product company, right? What do you see as the top 1 or 2 research issues or unsolved problems in AI and ML at large that kind of slows the widespread adoption in this industry? So when you think of it as a product company, is there one or two core tenets in AI or concepts in AI ML that is just unsolved and that serves as a pain point in terms of product development, particularly in terms of addressing customer need?
Sure. So we have two products. One product is blessed with a lot of data, which is public, which Tengen AI is market data. You can't go wrong with market data, right? Of course, the data regime can change between what was market data 10 years back is not the same as how market behaves today. So the regime change problem might be a broader issue, even though you have a wealth of data out there. But the larger issue that we see on the Eagle Eye product is we are trying to detect fraud in trading transactions. But what is the frequency of fraud appearing? As Mr. Mukesh was saying, you have 6 billion trades that's going on. So the number of frauds that may be happening in relation to 6 billion is probably a few hundreds per day. So it's just that complete imbalance of good versus bad, and you don't have enough data. That's one problem, is the imbalance of data. The second problem is the access to that real data. We can fabricate any amount of data in a synthetic manner, but that's not real. So we may have results that says we can detect fraud in our lab, but when you really put it to use in real world, it may not actually detect any fraud at all because you haven't really modeled it with any real transactional data. So getting access to real data is very difficult unless it's a public organization like NSE that's willing to share this information to the broad market there. But if some data is there in a corporation, obviously it's a very private data that they're not going to let go of, let it out, right? So it's within the firewalls of the company. So data is the problem. So AI is driven by data. It's very hungry for data, but you don't get good quality data all the time. And that is the number one problem that I see is, yeah, we cannot claim that we have solved any problem until that model actually has seen real data.
Got it. Got it. So one of the other questions that come up in multiple forums is, given that this product is very data centric, how do you account for, or do you account for, crises? It could be the Suez Canal, or it could be a pandemic, or things that don't really conform to historic data and predictions, because that's a huge part of the risk profile for customers. What are your thoughts on that?
Yeah, I think these are Six Sigma events that happen, right? If something is encountered for the first time, naturally everyone learns. So the way I look at AI is really human intelligence in the machine. I guess that's the way that everyone thinks about, is as long as you provide data, we learn as human. We are not able to predict something that has never happened in the past. Machine is also the same, right? It has never seen something, so it's not able to relate to the unknown unknowns, right? Or the black swan events in a different way. So I think these are factors that need to be considered as things that will still be outside your realm of predictability. That things will happen, which is not something that you can forecast. But you need to, I guess, design your solutions in a way that you can react to it and probably come up with some risk mitigation way of doing things. So you can't predict, but at least you can react, right? So
Got it. Here is a question on the Tengen product itself. How does it work towards personalizing recommendations at scale? Given that, first of all, it sounds like it's really important to understand the risk profile associated with individuals. And so to what extent does it depend on self-reported information on the risk profile, with the caveat that many times people might not know what their risk profile really is, so or what their goals might be. So how does it balance between self-reported notions of risk profile versus systemically scaling and understanding risk across the board?
So we have devised a bunch of questions that doesn't exactly ask the question of what would you do if this were to happen. So it's in a convoluted way, almost like a behavioral science. We are trying to gauge what the investor's risk profile is. So that gives us a flare of like the real true risk profile of an investor in about 15 questions or so that we ask an investor. Um, and this is not something that we designed. These are designed by behavioral scientists, and it's all in public domain that we just basically take from other market players out there in terms of how they ask the question. But then we also uh, supplement that with the age of the investor. So say, for example, an investor is a 60-year-old investor. He says, I want to take all kinds of risk. This is my life savings. Obviously, you cannot be very aggressive if this is a life saving and he's a 60-year-old, he or she is a 60-year-old person. So you really have to put that age as a factor. And then no matter what, this person cannot be more than a moderate, even though this person thinks that he is a very aggressive investor. Similarly, somebody who is young cannot be very conservative. We have to give the fact that this person has got, a full life ahead of him or her. And even if there is a market correction, that can be adjusted. Of course, if the investor says I'm very conservative, they are very conservative. But if the investor says they are moderate, maybe they are moderate plus, which is aggressive. So we do take that into consideration in terms of personalizing it, along with the standard questions that we ask, which is sort of behavioral in nature, and talk about what is their appetite for risk in general. Like if let's say the market were to correct, would you invest more? Would you actually liquidate? Or would you stay put? So these are like, a bunch of questions given, 4 or 5 different ways, then you can really say that, okay, this person is not just clicking, randomly, and that person is able to like consciously make that decision. So that's really a proven kind of a technology. We won't take the credit for it. There are other players who are doing it, and we are just following it.
Got it. So here is a two-part kind of question. I mean, you had mentioned that the retail or individual investor lacks knowledge, about the whole set of stocks that are available. And so to some extent, a lot of the decision making is hearsay. You mentioned the social circles and, how they perceive things from perhaps the media and social circles. So it's a two-part question. One, how do you correct for chronic biases? So one of the attendees has pointed out that this might just mean that you're always investing in large cap rather than small cap because you're just aware of certain companies, and this might be at odds with your risk profile in general. Right. So is there something that explicitly brings in, and this is partly the second part, which is brings in the behavioral economics component of it explicitly to say, we expect a bias of a certain kind because you come in with a certain knowledge base or hearsay, and given your risk profile, this is the kind of correction. So I guess in very quick summary, how much of this is behavioral econ also, right, into the whole process? And two, are you looking at it in terms of systemic biases through the channels by which customers hear about stocks or make decisions about stocks?
Sure. So we have certain quality measures that we have in terms of, one, the universe of symbols that Tengen is willing to score. So we cannot score, let's say, a penny stock, because it is a penny stock and it can go 100 times in for no reason, right? Because it can, right? If something is trading at 10 cents, it can go to $1 because somebody made a mistake. And this is something that happened. Zoom is a platform that we use for all these conferences, but the actual Zoom as a symbol was some other stock. And because Zoom went up, a penny stock actually went up, started trading almost 10,000 times, right? So, I may be exaggerating there, but that thing happens with these penny stocks, and we don't want investors to burn their fingers by investing in those stocks. Yeah, it may actually go, but that's not something that we are going to advise the investors on. So we do have some bias on our engines to be selective about what stocks we want in the universe. But we do have mid-cap stocks. We do have large-cap stocks. We want stocks to be trading at a certain volume on a monthly basis for us to be actually treating, because if you want it to be liquid, particularly during market corrections, you really don't want to pick stocks which is very illiquid or which can swing quite a bit, right? You don't want to like have a huge market impact on your transactions. So we do have certain yardsticks in terms of what is Tengen. So in the US, there are about 10,000 stocks and as much ETFs. But our investment universe in the stocks is only 1,800 stocks in total. So we don't really go beyond that. And we can have quite a lot of value with 1,800, right? So when an investor has a bias, what we don't want investors is to have a bias only on these big, popular name, large cap. It's, you know, everyone cannot be investing in Amazon and Google and Microsoft and say, yeah, I'm going to keep making money, right? That's just not the way the market works. And at some point, things saturate and they may not grow more than where they are right now. So we are looking at the universe of all the investment quality stocks that I mentioned, the 1,800 stocks and about 500 different ETFs. And so now the universe is bigger than what the knowledge of the investor is. So from that, we are able to percolate like good quality stocks and construct a portfolio which is well balanced, diversified enough across multiple sectors, and have basically the value that they can enjoy by investing. No matter what the risk tier is, there's definitely value to be had by looking at the broader universe.
Got it. I have one last fairly facetious question. What would Tengen have said about GameStop?
Don't go there. Actually, you can go to Tengen app that says, if something is extremely volatile, even though GameStop is actually a stock that's investable by the definition I mentioned, because of the extreme volatility, actually Tengen says don't go near. Tengen is not ready to advise you on this particular stock. We won't even say recommend a buy or sell or a hold. We'll say we have nothing to say about that. So in places where we say stay away as far as possible, we say that and run away if you find it, right? Because who is going to be impacted by stocks like GameStop are the retail investors. It's not the hedge funds, even though the stated objective is to actually go after the hedge funds on this. Maybe few retail investors might actually catch that train early on, but most of the people who just follow the Reddit gang, the retail investors are the ones that's actually going to pay the price for it. And it's something that Tengen will not recommend any investors to go near.
Got it. So Shyam, again, I just wanted to mention that there are a lot more open questions. We only had time for a few of them. So please do look through the Zoom Q&A and perhaps you could answer some. Many of them, I think most of them are asking when Tengen would be available for Indian investors to invest in perhaps the NSE. So highly related to our panel today. So
absolutely, we'll keep you informed, but our current plan is 2022.
Great. Thank you so much, Shyam.
Thank you, Professor Nandan. Thanks a lot.